hey, you have a buyer and a seller that agreed on this price, and just because, you appraise it $25,000 less, they should be able to buy it. Well, that's fine. If it's your money, like if you want to just pay cash, if you want to pay $450,000 a year cash, you can do whatever you want with it. But realistically, when you buy a house and you're loaning, 90% of that money from a bank or from some sort of an institution or a lender, it's really their money. And so
welcome to Get Real 411, the podcast where real experts give real advice on all things real estate. I'm Jamie.
And I'm Brad.
Join us as we explore real estate successes and pitfalls through the eyes of our esteemed guests.
Now let's get real.
We are super excited today to be joined by Jon Tallinger, partner at Class Appraisals, one of our favorite partners to work with at AmeriFund. Jon, welcome to the show.
Happy Friday. Great to be here. Thank you guys so much for having me. I'm excited to chat with you.
Yeah, this is going to be a very informative session.
Yep.
And so relevant to everything happening today. So I'm going to just kind of dive a little deeper in the introduction, Jon, before we kind of get into your story and giving our audience more information about appraisals. And really, it's appraisals of 1 to 4 family properties. But the appraisal business has gone through tremendous change in the last, say, 12 years or so, maybe closer to 15 now. And so we're going to dive into all those things. Jon has been on the cutting edge of those changes. He's been a decision maker. He's sat at the tables of those folks that talk from a very high level about how appraisals have evolved. The company he has, Class Appraisals, is what's called an AMC. And I'll let him explain what that is. But these came about after the 2008 crash, and I'll let him explain why. But really want to get into kind of all about appraisals, what they are, what they're used for, like kind of the basics. And then, Jon, that we can kind of dive into like regulatory changes, what's coming up, what things Fannie and Freddie are doing to make it easier, maybe even the cost of appraisals and that sort of thing. Being that you're a nationwide appraisal company, I think that this is information that our audience really wants to learn about.
Well, I think it's really important, Brad, because we've all seen, here we are closing out 2023. We've all seen the market reports. We are all fairly confident that 2024 is going to bring about some additional refinance opportunities. So what does that mean? It means we're going to have a lot more appraisal orders, and it means that property equity and values are going to be very, very important to loan originators out there today. So it would be really interesting to chat a little bit further about what we came out of in 2020, 2021, what we might be heading into here in 2024, and what some best practices are.
Yeah, but let's start, Jon, with your story. Like, how did you get into this business? What was your path?
Yeah, we all have some wild story about how we were naive or stupid or crazy enough to get into the mortgage industry to some extent. So I was 18, so a lifetime, more than a lifetime ago. I was a senior in high school, and my brother-in-law still owns a big nationwide AMC, and I just kind of started working for him, just kind of in the office, make a little bit extra money, and he was nice enough to kind of put me through my appraisal classes. So it was kind of cool. I graduated high school, and I decided to go to Michigan State. So I went to Michigan State, got my advertising degree, got out in 4 years, and every summer I would go home and I would go back and I would apprentice and work at the appraisal company. And when I graduated, I had an advertising degree from Michigan State and I had an appraisal license. Well, in 2002, the overall market wasn't great. And moving to Chicago to make 24, 25, 26 grand a year in an advertising job and having, trying to get my parents to subsidize the living cost wasn't a good option, and I could go right into appraising and kind of have my own little company, and so I did that, and I was able to make pretty good money. But at 22, 23 years old, even though I had kind of had off and on 4 years of training and apprenticeship, you get out in the field and you kind of learn on the fly a little bit. But I looked back after my first full year of doing it, and I'm like, God, I did not know what the hell I was doing a year ago. And it's not, that wasn't just an age thing. That was me at 22, 23. But there's a lot of people that became appraisers, that used to sell insurance. They got into the appraisal game and, in their mid 40s or 50s. And everyone goes through that process that it's just one of those businesses that, one of those industries where you just really, so much you have to learn through experiencing different types of properties, different types of situations. There's a lot of things that go into it. So that's kind of how I got my start. I appraised houses for about 7.5 years all over Metro Detroit. 2008 happened, which we all know was a mess, and kind of the housing bubble crashed. And a major part of that was that, loan officers, if you can imagine then, it'd be like Jamie if she just was doing a loan or a refinance or a purchase, and I was her local appraiser friend. She'd probably have a couple, 3, 4, 5 appraisers that she worked with in her market. And, not saying Jamie would do this, but I get a call from the loan officer and they'd say, "Hey, GT, how you doing? I got this house. It's probably really worth 320, but we really need 340 for the deal to work." And that's what was happening to appraisers constantly in that
Yep.
2006, 7, 8 range. And fortunately, I had pretty good clients who were pretty compliant and didn't pressure me. I did have to stop working with a couple of them because I just wasn't willing to. Because the problem for the appraisers was, those loan officers were kind of hanging over their head. Well, hey, if you can't hit these values, I don't know if we can keep sending you work. So that's just one piece of what created that big crash and fallout in 2008. So 2008, 2009, they both parties kind of came together and passed the Dodd-Frank Act. And so that's how there were AMCs before then, but when they passed that act, that's when they really put the requirement in place for lenders to utilize an unbiased third party. So essentially, the overall ideology is that, hey, the person that's originating the loan officer, the loan advisor, really they should not know who the appraiser is or have contact with that appraiser until it's done. There should be an unbiased person that's going out there and they're appraising it based on their knowledge of the area. So that's kind of how that came into play. We started class appraisal in 2009. I ran it for the first, 4 or 5 years. We grew and grew and grew. We were heavy in the wholesale space, and we started to really grow outside of that. And we brought in some other leaders that really were much better and more fit to run the company. And it's not something I really enjoyed doing that much. I don't like dealing with some of the that day-to-day stuff. And I kind of found my niche in the growth, relationship, marketing, sales side of the business. So we've sold to private equity a couple times over the years, and we've continued to acquire other companies. And it's been a pretty massive change. And so we've seen kind of the ebbs and flows of the market and what's happened. But so we realize now when we changed our name to Class Valuation now, because it's a little bit more encompassing than just appraisals. But at the end of the day, we're here to make sure that we are essentially looking out for the borrower to make sure that they are, not overpaying, or that they're getting an accurate value of what the piece of property they're buying is. One thing I'll say really quickly is, people say all the time, not all the time, but you'll hear occasionally, well, hey, you have a buyer and a seller that agreed on this price, and just because, you appraise it $25,000 less, they should be able to buy it. Well, that's fine. If it's your money, like if you want to just pay cash, if you want to pay $450,000 a year cash, you can do whatever you want with it. But realistically, when you buy a house and you're loaning, 90% of that money from a bank or from some sort of an institution or a lender, it's really their money. And so they have to look at the worst case scenario. So that's what the collateral's for. That's what the appraisal's for. So we know that we're just one piece of the process, but as you guys know, it can be a pretty important piece a lot of times.
Yeah. And you really nailed it, because at the end of the day, we've seen the ebbs and flows of the business, and we've seen what equity does for people and how a lack of it can harm large lending institutions and land us in some pretty difficult situations as an industry. So my take on it is that AMCs protect the lender just as much as they protect the consumers in the transaction. And watching and being part of this whole evolution that we've gone through, whether we like it or not, the bottom line is now everything is about the data. It is about the data. If you get an appraisal report and you don't agree with something, then you have to substantiate the reason that you believe that it should be reconsidered. And you have to give the licensed professional an opportunity to respond to that. Now, in my world, the AMCs being involved in that process has been a benefit to me because we're working with class, and class has an entire leadership team with credentials and experience that allows you to look at a reconsideration of value, for example, and look at the appraisal report and essentially provide credible insight back to us if you're saying, hey, you know what, I think you're off base here. This is what we see.
Yep.
Or in the other, realm, hey, Mr. or Mrs. Appraiser, you actually missed a comp. You may not have realized it was here. And that happens. It happens all the time. Human error, things happen. So I am a fan because I have been on the other side. Brad and I had a pretty sizable company before the crash, and we were lending at that time. And so we didn't like it when we had, we saw local appraisers. It was always the same appraisal firms, always in the same area, and not always the best delivery of a valid appraisal.
And just to clarify, because we've said AMC so many times, but we really didn't define it. It's appraisal management company.
Yep.
And just a really kind of broad stroke definition is class is the company we place our orders through as lenders. And then they're the ones that contract out with the appraisers. So when they say creating that third-party management system so that the originator doesn't have that direct communication, they don't know who the order is with, et cetera, that's all managed by the AMCs. To the token that you had mentioned, John, that had existed previously, really not nearly what exists today because now all orders are done through AMCs. So, with the exception, obviously, of some banks and so forth that we know. But that said, very interesting kind of growth path you had. I find it more interesting that you find yourself to be unfit to run the company. So maybe
it's just, I remember in my mind, like 48 is a number in my head. Like I was the first employee, started hiring people, 10, 12, 14, 16. It was great. We got to like the 40s and, it's just, you have to really start to corporatize things as you grow.
Yep.
And, like having to deal with, Susie L from accounting who's called in, no show or called in sick 3 days in the week, like that type of stuff. I naturally wasn't that good at managing people, but through practice, I got pretty good at it. But really, like, you need to find something in life that really drives you. Like if you don't like your job, if you don't really enjoy it, then you're doing yourself a huge disservice. And when we started to grow outside of the few captive lenders that we had early on, someone needed to take that role and do it. And so we were looking to go hire someone to run the sales side. And I kind of thought, you know what, let me give this a shot. And at first, when I tried to go sell, I was terrible at it. Because I would try to go sell. Like, and you think about like someone who comes door to door to sell it to you, or someone that calls you on the phone. And for a couple months, I just did not have much success. And then I just kind of abandoned that. And I started traveling, and I started going to events and shows and conferences. And I just got to know people. I just made friends with people.
Yep.
I asked a lot of questions. I listened a lot. And I started to build all sorts of connections and networks. And then I started realizing that I can piece people together. The industry is huge, but it's really not. It's very, very tight-knit. And I started to offer value to people without any expectation of anything in return. So a lender, years ago, Stearns. We didn't work with Stearns. We were not approved with them yet, but I became friends with some people that worked there and stayed in touch with them. And it's about being in the right place at the right time. When there's an opportunity, maybe we're the next man up. But I remember one of the VPs from Stearns I was kind of friends with, and he was looking for like a whole group of AEs in a certain market in the region. He needed like a regional VP, and he needed some AEs in that market. And I just happened to know some good people that were candidates there, and made warm introductions and kind of passed them off. And I kind of felt like, hey, that felt good to do that, knowing that I'm probably not going to get anything in return. And down the road, it paid off. And then some of those people that I helped place in those roles moved on to bigger positions other places. So that's kind of how it started. So I realized that selling is not really about selling. It's about, first of all, being responsive, like answering your phone. Someone needs something, you help them out, and being likable and offering some sort of value. So, and that's what I do every day. I mean, since I started the company, I've told almost everyone I meet, hey, here's my cell phone, here's my number, here's my email, call me, text me, whatever. If you need anything, come to me directly. Well, now we do, 50,000 plus appraisals a month. Very different from when we were doing, 500 appraisals a month. So at scale, if you say there's 20 or 21, 22 business days in a month, that's a lot of orders in a short amount of time. So but I still, that's what sets me apart. There's a lot of things that I'm not great at, but one of the things that I am good at is, hey, you know what? I will respond to those people quickly, and they can text me, Facebook message, LinkedIn message. Yep. And if they need they need something, I'm going to get them to the right place at the right time. And it's really the 90-10 rule. Like 90% of the deals we do go through smoothly. That 10%, they're escalated and they really need that hand-holding. That's where you can really win in those relationships, is being there and being responsive, and you build that trust.
And you are.
And you are. I can attest to that, obviously. Yeah. I mean, we go back a ways, and like today, last week or the week before, I had something, and I immediately contacted you, and like within minutes, an entire team of leaders at class was like, let's do this. Done. But it is about relationships. Very similar path for me, as I've been really involved with broker community and wholesale, is that same thing, right? We're out there, we're talking to people, we're listening, we're hearing stories, we're seeing needs over here, and we're seeing opportunities over there. And you just kind of wake up in the morning and you're like, just be a good human. Like if something's really obvious to you, you can connect dots somewhere and make something better for people, then do it. And you're absolutely right. At the end of the day, the intention wasn't there's something in it for me, but by doing that repeatedly and consistently, your reputation is good, and people want you to win, and they want to help you, and they remember the good things you did for them. And you're definitely one of those people, in our community.
Oh, thank you. We all have a common friend, a big leader in the industry who he's got a great line that he uses a lot that I think really rings true, is that you don't chase money. Money follows success. If you go, you build something successful, you do a good job, you do the right thing every day, money's going to follow. And then that's kind of how you have to look at things. I'm like, we've really gotten sick of the word LO or loan officer or loan originator. I really like loan advisor or mortgage advisor, because really, I mean, think about 21 and parts of 2022 where the rates were so low and refis were falling out of the sky, and you had more business than you can actually handle. I think about how many loan originators or mortgage advisors, how many of them really thought about, like, hey, what's best for this specific, like this couple that's buying this house, or they're thinking about refining their house. Yep. What's the best move for them and their future? Is it just to do what they came to me for? They think they need money for a refi, or if they're lower rate or this, or buy this house. What's best for them? Like, can they really afford this house? Or like, so are you really giving them advice, or are you just doing the deal as transactional? And that's part of the problem with the industry. There's not enough people on all sides, and every line of work, whether you're a mail carrier, a mortgage originator in the appraisal business, you're going to have the goods and the bads. And just like you talked about before, sometimes there's bad appraisers. There's bad appraisers out there, no question. I can tell you the majority of the time that you get an appraisal, that appraiser is pretty credible. They know what they're doing, and their appraisal is probably accurate. But there is that percentage of the time where there is something wrong. There's something that's questionable that needs to be looked at. But at the end of the day, it's about doing the right thing, and that's how you build a sustainable business. That's how you build trust. That's how you guys have built the names that you guys have, by consistently doing the right thing.
So, John, I was obviously teasing. I don't think you're unfit. It was a funny choice of words. But a lesson just kind of outside the appraisal thing, then I want to change gears here, is you find something that you like to do, then you become good at it. And that's how you can really make a difference. And so you're an owner of the company, but you're doing what you're really good at. And so that's a lesson for anybody in whatever field, right?
Well, yeah. And I think that you hit on something else that's really important, and it's extremely timely for us, because obviously, in addition to the podcast, we've got AmeriFund. Education. Yep. We have a massive lack of it in our industry for newly licensed loan advisors who aren't advisors yet. They're licensed loan originators, to educating our consumers to educating our real estate agents. And for us, it's been probably the greatest focus we've had over the last 30 days as we head into the new year is how do we create something that when I'm not originating anymore, which I hardly do anyway these days, like what are we leaving in our industry? What is our company built on? Is it built on a group of people who we are actually teaching to be good stewards of their craft? Or are we all just commodities and we're only as good as the lowest rate we offer and we're turning and burning customers never to be seen again? Sustainability is about consistency, but it's also about doing what's best for your client. And sometimes for Brad and I over the course of our career, that's meant not getting a loan through us. But if it's the right thing, that person's going to come back and remember that you did the right thing the next time.
I'd like to change gears and really focus on the appraisal subject. So let's talk about regulation. So the biggest change that's taken place since the crash in 2008 was the AMC Dodd-Frank Act, creating a separation. Other things have taken place over the course of that period of time since then. But what's also on the horizon? What's changing? Because we know that there's automated appraisal values and that sort of thing. Maybe talk for a moment about that and what you guys are doing to be on the cutting edge of that.
Yeah. So, and I'll keep it as brief and to the point as possible, but there's a lot to unpack there. When I was appraising in 2000 and 2002, 2004, my brother-in-law, great guy, Dart and Case, he owns Dart Appraisal. They were just in Michigan originally, now they're a nationwide AMC. I remember him telling me, like 2004, him telling me, John, you go out and do appraisals right now with, this one type of camera and you have a notepad and a rolling wheel. But he's like, hey, 5, maybe 10 years tops, this is all going to be automated. Every appraiser is going to have a tablet. I didn't know what a tablet was back then. I was thinking like Flintstone style, but every appraiser is going to have a tablet and everything's going to be able to load immediately. And there's going to be much more technology involved. So, and he was right that that's going to happen eventually, but that was 2004. Obviously, 2014, that hadn't happened yet. And here we are in almost 2024. And that's still, there's still, I will say the mortgage industry in general, compared to a lot of the other industries that I'm very familiar with, is pretty far behind in terms of tech. You're seeing a huge wave of technology starting to really close some gaps and create some efficiencies throughout the mortgage process. The appraisal piece, just in a vacuum, is still very archaic. I can tell you when I was appraising in 2008 or so, I really felt like with what I had to go and walk through the property. I had to measure it myself. I had to see, smell, everything there. Now, it's kind of like when you go to the dentist. You go to the dentist, who comes in and cleans your teeth?
Yep, the hygienist,
not,
right?
Not the dentist, oral hygienist. Mm-hmm. Oral hygienist comes in, cleans your teeth, preps everything. They get the x-rays done. The dentist comes in to actually do what he went to school for. He reviews the x-rays, kind of looks at your teeth. And the highest and best use of that dentist's time is to not be cleaning everyone's teeth, giving you the toothbrush and the floss and all that stuff. Like maximize, the ability of those individuals. And that's sort of where we're headed with appraisals now. We have technology now, and class has really doubled and tripled down on this. And we've worked closely with the GSEs to help really drive appraisal modernization. So digital is something that you're going to start to see a lot more of now. There's already quite a bit of it that's already rolled out. One thing that's super prevalent right now that I would say, honestly, half the loan officers in the country right now aren't really aware of it, they're not utilizing, is these inspection-based waivers. If you're a loan originator, music to your ears is appraisal waiver. Like when you got an appraisal waiver, this is like the golden ticket, right? So they've expanded that now. So I'm not going to quote specific numbers, so don't quote me on these, but let's just say that 20% of loans right now that you guys do are eligible for a traditional waiver. Like, hey, the value is good. Here's the waiver. You don't need an appraisal. Let's just say now there's another 8 to 10% of additional of that pie, 8 to 10% that is now eligible for a waiver. However, you just need one additional step. You need to get the property data collection or property data report. That's not an appraisal. It does not need to be done by an appraiser. And all it is essentially, they want someone to go out and do a quick inspection of the property, capture the data, capture the video. We at Class, we have some phenomenal tech that we send what we call a professional, data capture expert. We background check them. They go out, they use our tech, and it scans the house and it captures all the data. And so those cost probably between $160 and $180. I can tell you, and there's some lenders that aren't even set up yet with their technology to be able to handle those yet. But 9.5, almost 10 times out of 10, you want to take that option if you can do it, because if you don't, I've heard some lenders and some LOs just say, oh, we'll just get a full appraisal. Well, the full appraisal is going to cost you $500, $600, maybe more.
Yeah.
And then you're also bringing other risks into play. Like the value is already accepted. But so what if the appraiser goes out and it comes in low? Or what if there's other issues or concerns with the house? So you're talking about money, more money in the buyer, out of the borrower's pocket, more time. It's going to still take that appraiser 5, 6, 7, 8 days to get that appraisal done. And also you're bringing in those other variables that don't need to be in play at all, where things can go sideways. So
why are they doing this? Are they missing it? Are they not understanding there's this other option? What's the missing ingredient here? Why would somebody consciously do that?
We go back to education. This is just something there's not enough education out there about it. There's not enough conversation about it. We're constantly doing webinars and lunch and learns for lenders and brokers and retail branches around the country. But it's the GSEs have done a really good job of creating some really good products. But I think I think one of the problems is in a market like this where it's really slow. I think so many lenders that I talk to right now, they love to say, well, appraisals aren't really a problem right now. So, and I think
they are,
and there's perceptions like people,
Yeah.
and I've come to realize that like data is really important, but perception is honestly kind of more often than not, more important. So you have LOs and real estate agents. So we get pushback from real estate agents as well who say, hey, I'd rather just have the appraiser come do it. I don't trust, some other person to come out here. And what if, in a small percentage of the time that they're going to do that inspection piece and the underwriter's going to look at it and they're going to see something they don't like. Maybe I'm just going to say guess 5% of the time, something they don't like, and then they need a full appraisal. With most of our competitors at that point, they would need to send someone else out and do a full appraisal again. For us, we've already captured all the data, so you just upgrade it, and it's just the total would be the same price, and then it takes one day or 2 days for us to just have the appraiser complete that out. But that's really where things are headed. Something really scary is, you guys saw in 2021 and parts of 22 when it was really busy, really, really low rates, complete lack of capacity from appraisers, where you had 2, 3, 4, 5 week turn times and fees through the roof. Yep. Nobody ever wants to see that again. Now, in our lifetimes, we probably won't see rates in the 2s or the 3s, but since COVID started until now, there's like 7,000 or 8,000 less appraisers than there were before. So even though we're not going to have as big of a squeeze on that much volume in that short amount of time, once we hit our new norm, like once we get back to a regular rate environment at some point, there's going to be a lot of markets where there's going to be a squeeze on appraisals. So we're going to be back to the same problem again. So how can we maximize that appraiser's time? Is the highest and best use of that appraiser out driving around, all over to 4 different houses around the county in one day and then typing the report? Or is it someone else is going and using data, much more reliable piece of technology that standardizes the data? So like our tech, when they go out and the inspection is done, it standardizes it. It actually measures using LiDAR to ANSI standards. So we could send 10 different people out to do the inspection and we'd have the same 10 results. Yep. And we could send 10 appraisers to go measure and we'd have like maybe 7 or 8 different square footages. Yeah. So the tech's getting way better. That's where we're headed. But it's tough to get adoption in a down market like this because people don't want that risk of the unknown. They'll say, well, I'll just take what I know. So.
No, you're right. It is education. Because, I even have friends, we text, one another often, and I'll have people that are really experienced and been doing this a long time. Like, has anyone ever used, a property data report? It's like, it'll be a little quiet, right, for a minute in the chat, and maybe one or two of us have. It's lack of knowledge. It's fear of the unknown. It's all of that. And I think that we are coming into a really interesting market here. And we are going to have a capacity issue, no matter how you slice it. So the more we can start to understand and adopt these kinds of cheaper, faster, and reliable solutions, the better we're going to be.
Yeah,
And
the most important is the cheaper at this point.
The cheaper, honestly.
Because, look at what's happened with credit reports.
Yep.
Ugh.
This is just data exchange, and credit reports are going up to, this is just data. This is like, it's not a full factual like we used to, where somebody had to call creditors and, do some, it's what, $75 for a credit report?
Some of them are more coming in.
A lot of more.
So,
yeah.
Anyway, the cost savings is huge. What other things are changing? What other things are on the horizon? And I know that you guys are working on just internally some things to help with that process.
Yeah, so one of the things that's been tough being, I feel like class is my baby. I've been here since day one, and we've grown, and we're at a point now where for years, like 75% of our business was wholesale. We were dealing with brokers and wholesale lenders. Now we're really well diversified as a company, and so we have like really 5 segments. We have banks, we have consumer direct, like call center, distributed retail, like a branch model. We have wholesale, TPO, correspondent, and then we have credit unions. And what I've always known and realized, but it's tough to do. Growing a business to scale is difficult. We went into COVID with about 200 employees. Now we've got about 600. We've done a lot of acquisitions since then. But one thing that's never gone out of style, and it never will go out of style, is white glove, world-class customer service. And I think that, with growth, 21, 20, even 22, parts of 23 were difficult for everyone in the appraisal side of the business because, when the rates were really low and volume was really high, we had appraisals holding us over the barrel. 23 was really difficult because you went from that tons of volume to lower volume. But what's really kind of come through that we've really come to realize and started to really embrace again is that client service. No matter how large you are, it doesn't really matter. Like Four Seasons, they're a massive conglomerate, but when you go stay at their hotel, you feel special, period. They don't make the excuse that, hey, we're really big, so we can't take good care of you. They will give you literally whatever you need there. And so that's where we've kind of returned our focus to. So we've sort of moved away in the last 6 months, completely moved away from maybe the lower paying hourly type employees. So we've taken the really good ones and elevated them and given them a bigger opportunity. And we've taken the ones that frankly don't really care, and we've sort of moved on from them. And we've really put a focus on, let's put the best communicators possible. Let's go find really good people, pay them more, and give them incentive, but also have higher expectations out of them. So like every single, as of, a month and a half ago, every single mortgage broker and correspondent that we work with has a dedicated AE, just like you would have at one of your wholesale lenders. Dedicated AE. They have so they work their regular shift, but they also have cell phones. And the expectation is, within reason, that they're going to answer the phone whenever you need them. So if you're on the West Coast and it's 7 p.m. out there and it's 10 p.m. here, you can call them and hopefully they're going to answer, or you can email them, but you're going to get one direct point of contact. Everyone likes having one direct point of contact. Not always the easiest thing to do. If someone's on vacation, someone's sick, you have overlap, but no one wants to call the front desk and get put on hold, and then they're going to put you through to a phone tree, and you're going to find someone out of 12 people, and you get a different person every time. So we've made that commitment for the Burke community, and even for our distributed retail branches as well, where you have one point of contact, someone who can, the entire process, whether it's assigning, whether it's questions about the appraisal, whether it's questions about, can we get it back a day sooner, whether it's questions about post, what's been delivered, revisions, things like that. So we've really upped the level of player on our team. And we just focus on finding people that really, really fit our core values here, and so that's been a huge difference. I mean, we realize like the market's very competitive now for you guys, for everyone else. We had to get better on that service front. And the only way you can, and that's how you really sell. I mean, the best way to sell at anything is sales through service. It's not going out and schmoozing someone, taking them to games, taking them golf and whatever. you know what, if you guys send me an order and I do a great job and knock it out of the park, well, common sense is going to say, you're going to want to send me more orders because I'm going to keep doing that. And if I keep doing that time and time again, you build trust, and then there's a real relationship.
Yeah. Very good. Yeah. That goes across the board with everything that we do. I'm just curious, kind of taking a step backwards when you said we lost 8,000 appraisers over the last couple of years. The market's changing. Rates are down over a point in the last couple of weeks, which is a big movement. There's expectation that'll continue. Things get really busy. Is there a chance we see this mercenary type of pricing again, where appraisers, because there's so few of them, and when you need an actual appraisal and not just an inspection, that we're going to have to see doubling of those appraisal costs?
Well, there's a chance for anything. Is there a high likelihood of that? I don't think so. So that's why we work closely with Fannie or Freddie, and because I don't speak with them on a regular basis, I don't like to say too much about it, but we have some really important people in our company that have really close relationships with the GSEs, but they're very, very sharp. They are forward thinking, and they've for a long time now been looking down the road. So for years, we always heard these changes were coming. They're here now. Like, we actually have the eligibility. We have the ability to do desktop appraisals, which we do a lot of, but most people don't realize it, or they don't utilize them, because in this market, they just want to go with what they know. But, and it's a certain bucket right now. So desktops are eligible for Fannie or Freddie, like single family, primary residence, 90% or less LTV, couple other little steps, but there's a good amount of loans that are eligible. But it's kind of strange the way they have it worded. When you look at your findings, like line number 21 will say requires a full 1004 appraisal. Okay, which seems pretty clear, like you need a full appraisal. But you go on to like line number 25, it's like eligible for desktop appraisal. Well, so I don't care what AMC you're talking to, whoever it is, depending on the market around the country, some might take 4 days if they're really fast. Some might take, you're probably still 5-6 days, and then some outline markets longer. We're doing desktops in 48 hours. Like, that's our commitment. And so what that means is when we have a nationwide network of scanners all across the country. So even out in the sticks, we get the order, and if it's desktop and it's eligible for desktop and it's ordered as desktop, we have the scanner go out within 24 hours, get everything back to us. And the pack of data that we receive, that we send to the appraiser, is so substantial, it's unbelievable. Like, if you've ever seen like a Matterport report, or like when you go like on a home listing tour and you see everything that, you walk through the entire house, you scan the next room, that's what essentially very similar to what the data that we supply from the inspection piece. So the appraiser sitting at their desk has all that data, and essentially within 24 hours, the appraiser's completing it and getting it back to us. So even in this market, you think about it right now, like, we have a handful of correspondent lenders and brokers and lenders who are like, this is gold. This is the best thing going. Don't tell anybody else about it. I'm going to keep doing these, because everyone down the street, it's 6 days on appraisals, and we're doing them in 48 hours. So those are in place today. Those are out there. Not many people know about them. But my understanding is that the GSEs are going to continue to push for more and more monetization or more utilization of that type of product.
Open that bucket up.
Desktop. Yeah, where you're bifurcating the appraisal. You think about it, and at first we had, I think there was a lot of skepticism from appraisers out of the gate. They feel like anyone else, like, hey, they're trying to replace us. And I can tell you, we're certainly not trying to replace the appraisers. We're trying to make their life easier. And the amazing thing is, like, I live in Michigan. And so for like 3-4 months of the year, it's cold, it's snowy, it's terrible outside. I think about like the 67-year-old appraiser who lives down the street here in Michigan. If he wants to go spend his winters in Florida, he can. And he can sit at his desk there.
That's a good point.
And still knock out, like, we actually, like, where we're headed with technology, you can prolong the lifespan of that appraiser. And instead of doing 2 a day, where they can drive around and do the whole report themselves, now they can do 4 or 5 a day sitting at their desk in Florida on the appraisal that's in Troy, Michigan here. So there is things like that are what's going to help offset the loss of, some of the appraisers who just retired and got out of the industry in the difficult time last
Yeah,
couple.
the lesson there is really have to pay attention and really scan that approval that comes out through desktop underwriting.
Yep.
And
Got to read your AUS.
make sure you understand it. So
Yeah, and if you
we
ever want,
appreciate.
we're more than happy. Like if it's you guys or if it's anyone from your audience, if it's a group of agents, if it's a group of brokers or whoever it is, we'll jump on. We'll do a 30-minute, and we'll even send lunch at Lunch and Learn. We'll do it remote. We'll do it in person, and just kind of walk you through kind of how that process works and what the benefits are for you. We do it constantly, and that education piece is huge. Just knowing that you have those options is
Well, we'll take advantage of that for
Yeah,
sure.
for sure.
And then,
Yeah.
if you don't mind, we'll put your contact information underneath the post
Absolutely.
of the podcast and put that offer out there for others.
absolutely.
Yeah. Well, John, man, this is really exciting. Appreciate all the information that you've given us, and keep in touch with us on those changes. If we can sign up regularly with you, and just to stay on the cutting edge and keep apprised of that, that would be helpful for us. And I know Jamie likes to ask a question of our guests to kind of close things out. So
I do. This will be good for you, based on the story that you shared with us. So, if you today had an opportunity to go back in time and talk to high school, college age John, knowing everything that you know today, what would you tell him?
You know, that's a very loaded question. I could take forever answering it, but I'll keep it simple. I just feel like life is a journey, and the good things, the bad things that happen to you, the good people, the bad people you meet, you interact with, the mistakes you make, that's what you learn from. You know, I'm pretty happy. I enjoy my life. I enjoy what I do. I enjoy the people I work with. I'm very blessed to have an amazing wife and 3 amazing daughters. And a dog who's a pain in the butt, but a great dog. So I wouldn't change much. I mean, I would, there's a couple little things here or there, but, I wouldn't have worked harder in school necessarily. I think that some of those life experiences, at college and high school, some of the stupid things you do or some of the fun things you do are kind of what molds you as a person. The only thing I would go back and probably tell myself to do maybe a little better is trying to find more balance sometimes. I think in our industry, unfortunately, there's a mentality, and I'm not judging, but there's people in the industry that, hey, I'm going to be in the office at 4 a.m. and I'm going to work till 8. It's really, really hard to find balance in your life. And you know what?
Yep.
It's all a matter of like what drives us, what we want, what we consider success. But finding that balance, like Brad, if you were in the office at 4 a.m. every day and left the office at 8 p.m., you'd have a total dad bod. You wouldn't be buff like that. But also, you get to go to the gym, you get to go to work out, and it's good for your mental health.
It's all genetics, John. I don't go to the gym.
Oh,
but you know
whatever.
what I'm saying? Like, I wouldn't change that much. I mean, there's in this crazy line of work we got into, the ups and the downs, I enjoy it, and I just like you guys, we're very fortunate. I'm very grateful for what we have. Got a great company and great people and a great industry. And look, we go through the tough times together. We go through the good times together, and we fight through, and the strong survive. So
We are resilient, and we are an incredibly supportive community. And I'm excited because I know we're coming out the other side of this thing. You guys are going to be standing there with us. Lots of our friends in the industry are going to be standing there with us. I think we're on the horizon of better times ahead.
Agreed.
every major change in the economy, markets, natural disasters, there's always opportunity on the other side. So, I'll leave kind of at this, I go to these conferences all the time. I went to the NBA annual month and a half ago in Philadelphia, and I'd say about 60 to 70% of the people I talk to were basically playing what we call prevent defense, where they're just kind of on their heels. They're worried. They're very glass half empty. I don't know. It looks bad in the future. And the other 30 or 35% were like, I'm in. This is amazing. This is great opportunity. I'm going to work harder this year and make less money, but I'm going to lay groundwork to make things long-term sustainable and build it better. And so that's the mindset. That's the winner mindset. That's what we all need to have. That, look, there's going the ebbs and the flows. They never stay. So the bad times, they don't last for that long. Winston Churchill said, if you're going through hell, keep going. I think
Go through it.
I think we're, for the most part, through it. And there's a lot of good times ahead, and we're going to see some great things ahead, and the strong are going to survive. So, and I'm
Well, awesome, John.
be there with you guys,
Yeah, love it.
Thank you for joining us today. honestly, and you have a great and happy New Year with your family. And
guys too.
we look forward to continuing to work with you.
Yeah, we'll see you guys soon. Drinks on me next time, of course.
Love it.
All right.
Get Real 411 is hosted by Brad Rice and Jamie Kavanaugh, produced by Stuart Jellin, and recorded live from the AmeriFund Home Loan Studio in Simi Valley, California. You can learn more about the show at getreal411.com and watch full episodes on YouTube. If you're interested in being a guest on Get Real 411, email booking@getreal411.com. Please subscribe, rate, and review us on Apple Podcasts, Spotify, or wherever you get your podcasts.